Welcome back to Turning Hard Times to Good Times. I am your host, Jay Taylor. Really pleased to have Frank Holmes with me once again. Frank is the CEO and Chief Investment Officer of U.S. Global Funds, the group of funds that specializes in natural resources and emerging markets. He is well known for his expertise in precious metals in that sector, as well as his general overall strong investment track record. And I should say before we say hello to Frank, the website is usfunds.com, usfunds.com. Thanks for joining me, Frank.
It's great to be with you again, Jay. And we have a better gold market.
Oh, yes, it is a happier time for us gold bugs, but it's happier in one way, but in some other ways, a lot of times gold does very well when a lot of other people aren't doing so well. So I don't cheer for higher gold prices, because other people are suffering, if that's the case. But in any event, Frank, I'd like you have a holistic approach to investing. You like gold very much. I know you're specialized in precious metals, but you have a very balanced approach to investing as well, better than yours truly has. I'd like to ask you to talk just briefly about your group of mutual funds and just let our listeners know about the kind of investments that your mutual funds are engaged in. Then I also want you to talk about a couple of your ETFs as well.
Great. Thank you for the opportunity to share what we do. U.S. Global was the first no-load gold fund in America in the 70s, and its success was because South Africa was paying massive dividends, or like 20% dividend yields.
Yeah.
And so that was sort of the genesis of it. And then in 1990, I moved from Canada down to Texas, so I became a Texcan. Y'all come back. Hey. And with that, I tried to revamp, and we embraced big money market funds at the time. So we had the ability to go between the gold funds and go to U.S. government bonds, that was sort of a big run. So interest rates went to zero, and then we repositioned so that holistic approach, Jay, is that we have a very stable tax-free fund called NEREX. It's short term, and it stays around $2 a share. And it pays monthly dividends, and that was always sort of the core position that you have, and then because it's tax-free, and you have the gold funds. And then we have big blue chip funds, and we also have a short-term government bond fund. But that's sort of the holistic approach. And one of the things we noticed with gold, and what happened in the 90s, was the buyers of gold, the growth was out of Asia. And so I went over to Asia on a tour and saw that when 1991 communist China was back then, the airport was in Beijing was so terrible when you think about what it is today. But you could go to a shopping mall and there'd be gold traders at the back. So gold was a part of their culture, and I saw how fast China was growing, so I started a China fund. And then I saw Eastern Europe and the wall came down, so I started the first Eastern European fund. And that gave me sort of the whole global picture. And what's really interesting in the past couple of years, some of the biggest buyers has not been Germany and not been Italy or France. It's been Eastern European bloc countries which have become big buyers of bullion of their central banks. So it's been, an interesting turn that I could see the world turn going from Asia to America to Eastern Europe and then come right around the earth.
Yeah, the countries where they've had communist rule or where they've had difficult times, they've seen how governments can screw up the economies so badly, and they're with their currencies, of course. And so I guess maybe that's the reason those areas have been so bullish on gold. Probably the Chinese, certainly, as soon as they were allowed to own gold, they started buying it like crazy, right?
Absolutely. And it's a really strong data point on Bloomberg that shows the rising GDP per capita and that they just buy more gold. So they gift giving, and I call it the love trade, and 60% of all gold demand is for love. And so I think that's a steady backdrop for what we're seeing now. And then we have the fear trade, and these fear trades can last from a year to 3 years, and I think we're in a 3-year run here where we're going to negative real interest rates, especially out of Europe that's driving that, and Japan. And you have something that's unprecedented. The Federal Reserve cannot buy the S&P 500 index ETF. But in Switzerland and in countries like Japan, they own 15% of the stock market. They print funny money, and they're out buying the stock market. They've not been buying gold. Whereas Poland and Hungary, as for a classic example, they've been big buyers of bullion.
Yeah. What do you think you think our Federal Reserve might do something like that, like the Swiss bank, to start buying equities?
There'd have to be a change in the federal charter. That would be a big political move. I don't think that's going to happen. But what's important on that love trade, I like to tell people, is that Indian women wear 6 times the amount of gold that's in Fort Knox. And some people don't believe the gold's in Fort Knox, but Indian women, I always can see the gold. That 24-karat gold is gorgeous. So I think from that end, in my global travels, I was just recently in Europe, and I just couldn't believe, Jay, how expensive it is. I mean, it really is. And the other positive part, though, is dominated by Chinese tourists. All the 3-star and 4-star hotels were sold out, so the 5-star were outrageous prices. Like the gold show they always have for the Denver Gold Show, they always have one in Zurich. Well, the Hyatt was wanting $2,400 a night for a room.
Oof. Well,
because all the other rooms are taken up by Chinese tourists. I went to Milan. It's the same thing. I saw Chinese tourism, so that fits in well with my JETS ETF because that was a call that the rise of GDP per capita. Not only do you see more gold being consumed out of China and India, but Chinese that love capitalism. The first place they go to when they get to New York City is the New York Stock Exchange. They all have selfies. You can see them. It's amazing.
Really?
And we had a couple of weeks ago, is in New York City for a quick trip, and it was with the New York Stock Exchange to celebrate 2 years of Go AU, launching up the Smart Beta. And so that's my sort of refreshing moment of seeing all the Chinese tourists in front of the New York Stock Exchange. It's very positive.
So I want to ask you about JETS and Go AU, but also just a question about Hong Kong in light of the difficulties that are going on there now, and your Asia fund, your China region fund. What are your thoughts about Hong Kong, and what might that portend? How do you think that'll play out?
Well, the first big part is it's had a bigger impact on luxury goods and discretionary sector of the economy. And Cartier and Richemont, et cetera, they're expressing their concerns. But I think that it'll resolve itself. I think that we had just a unique leadership, both over there and here. And I think, it's the first president I've ever known that gets in front of the mirror every morning and checks how his hair is, and then he checks on the stock market. There's no other president that uses the stock market as a barometer of future growth and economic activity than President Trump.
Yeah.
And so I think that's really a unique pattern. And that whenever you've had an expanding economy, which we still are expanding in the U.S., and you have interest rates drop, there's 100% probability stocks will be up in 6 months.
Right. Yeah, that's statistically, yeah.
Yeah, it's a good batting average. I like that. That's like a 3-point shot, but you're only a foot from the rim. It's a good data point. But I think that I'm more bullish and constructive. August is always a treacherous month. That just goes back in history.
Yeah, statistically,
so you got to get over with. There's always something goes on. I remember when in 2002-3 with bad hurricanes. It was always so disruptive for the energy market. And so there's always something that happens in this time of the year. But I remain really bullish about gold, and I'm just trying to to explain to people that you're not seeing the fund flows in Europe going into the bullion ETFs. You are seeing it here, and you're not seeing it in Southeast Asia. So that I find really interesting. So it's really bullish for me that gold's going to trade higher, and I think that the juniors, the microcap stocks, they still haven't found a big bid. And so there's so many great values out there at this stage that there's probably more regulatory rules have made it more difficult for people to speculate in that space. And that's really what exploration companies are, speculation.
Oh, yes.
Someone's going to find something. and that's speculative money. But from a regulatory point of view, you're allowed to buy lottery tickets, and they never come back after that ticket expires. And you can go to the racetrack, and after that pony's run around the track, you're never going to get your money back. At least, penny stocks, they can always come back if they've gone down. They get restructured, or something happens in the cycle. But or you can go to casinos. And so the speculative money, and then the other thing is I've noticed the speculative money went into the crypto space. About $5 billion in 2017 went there. So to me, trying to eliminate speculative money is like prohibition. It was a disaster. Yeah. And people will always speculate. And hopefully they wake up to that there's a shortage of public companies. You've got to speculate for the juniors, like the cable companies today. Were one time penny stocks out of Denver. That's how they started. Jones Cable, 10-cent financings. Yeah. So these are sort of things I've observed in my global travels. Europe's extremely overvalued. I don't think they're trying to manipulate the currency. I think it's just outrageous that they wiped out $1 trillion. They forgave $1 trillion of bad loans, just like forgiving student loans. Like here, $1 trillion, forget about them. And they print that funny money, and the Bank of International Settlements is complicit with all that. They'd rather take money from Venezuela's central bank, corrupt economy, or Argentina than they would turn around to do a cryptocurrency or gold. So that's something I really discovered when I was over there that made it even more so. And for your gold listeners, what's interesting, for the past 20 years, Morgan Stanley's just come with a nice piece of research that the best performing asset class have been REITs. But number 2 is bullion.
Interesting. Over the last, how many years?
20 years.
Last 20 years.
So, and the biggest hedge fund in the world, Ray Dalio's Bridgewater, he's 6 to 10% long bullion. And he does a parity trade against his other asset classes and trades them, goes on and out of the market on a regular basis. And so when you think of that, here's the number one largest, most successful big hedge fund that's always got a 10% exposure to gold, and gold's the second best asset class. So I think that and I met Ray Dalio in early 80s at the Contrarian Opinion Forum with Ian McAvity, our old good friend.
Oh, sure. Who's
extraordinary chartist.
Yeah.
And I was a young kid as an analyst, and he took me on a trip down to Montreal, and we drove down through the beautiful mountains there and in Vermont. And so I remember, what a brilliant guy he was at that time, and what he is today.
Yeah, for sure.
This thesis on gold is real, and let's talk about it. CPI is in the U.S. is about 1.8.
Yeah.
And the U.S. government is trying to induce you or seduce you to buy 10-year government bonds at 1.55. So that means you're going to lose 25 basis points over 10 years in your money.
Yeah. Before you pay taxes.
Say, okay, well, let's go 2 years. Well, that's 1.5. So I'm still going to lose money over 2 years. And most currencies move off that 2-year note. And today, President Trump is pushing for 100 basis points drop in rates.
Yeah.
Well, that would mean that you would be, getting, that would propel gold to 2,000. That was, the last time we had a 300 basis points negative rate of return was in 2011, and gold hit 1,900. So I think this is a different scenario, but this race to zero interest rates is very, very much steeped in the psychology by so many governments to accept. The other thing is the daily volatility. It's just to really appreciate that the daily volatility of bullion is plus or minus 1%, 70% of the time, and so is the S&P 500. So, in fact, bullion is not more volatile than the stock market, as a lot of these talking heads on CNBC always say. But what's interesting is that gold stocks are more volatile, and they're more like biotechnology. It's not event for on a daily basis to go plus or minus 3%.
Oh, for sure.
And so it's important for investors to recognize that the volatility of the gold stocks does correlate 94% of the time in the direction of bullion. and gold stocks just have more volatility to them. And so when we get these corrections of 100 basis point sell-off in bullion, it's usually a great time to buy gold stocks when you have a trend like what we're witnessing, that is rates going to continue to fall, the world is worried about a slowing economy, and there's all these structural imbalances that more than 25% of the global debt of governments is offering negative real rates of return. Well, that's just a real positive scenario for the fear trade for gold.
Yeah, it's hard to see anything more positive than that. I have to ask you, Frank, gold, the safe haven, so when we have risk-off days, we see the treasuries getting stronger, yields going down, and gold usually, too, has been behaving very well. What do you think, when do you think that might change? When do you think that treasuries might no longer be seen? When you get to zero interest, who wants to buy those things? Well, why would you want to buy them now, as you just pointed out? But do you see a point in time, and I can remember in the late 70s, I can remember when treasuries weren't the place to be. Interest rates were rising like crazy. Inflation was really picking up. Our first guest today, Michael Oliver, he believes that we're headed for something akin to the late 1970s. Do you see anything like that as a possibility?
Well, you had rates rising in the 70s, but they were always massively negative. They're minus 7%.
That's right.
They were never rising fast enough to catch up with inflation.
Well, until Paul Volcker in 1980, Frank, and that's when that's what put an end to it. But up until then, G. William Miller and those, I think before him, before Volcker, who was Arthur Burns, those guys were just pouring fuel onto the fire constantly, weren't they? Just like they're doing now.
They were.
Like all the central banks are doing now.
Absolutely. The best-selling book is, just print the money. And monetary policies, you can keep up with regulations, but it's just not so, and it catches up with us, and I believe that we're in that scenario now. So what's the best way to play it? Well, it's gold stocks. And the reason for that is that whenever you have an expanding economy, as I mentioned earlier, and you have rates dropping, mathematically the odds are stocks are going to be up. Now, in all my research, my halcyon days of 2002 to 2007, when my gold funds ripped up, the competition, we were number one by a wide margin for 1, 3, and 5 years. We had a strong stock market, and gold was rising. So whenever you have a strong stock market and gold is rising, the gold stocks are just spectacular performers.
Well, we've certainly seen it. And Frank, with just 2 minutes left here, talk to us a little bit about GoAU. What makes it unique, and how have you performed relative to your peers?
Well, when we did the back testing, I spent 8,000 hours on it, trying to identify there's new buyers in town. The new buyers are quant funds, and quant funds are looking at different factors than the old narrative from Bay Street on NAVs and book values, etc. It's a new world. So I was able to, after 8,000 hours of research, identify those factors, and so I created AU, and it's basically 28 stocks. The problem with the GDX and GDXJ is that when money goes into them, money equally goes into shitty stocks, excuse my French, rotten stocks or bad stocks, as good stocks. So you get diluted, and all I said, I'm going to screen them. So there's 88 global gold producers. I'm going to automatically take 44 of them, and I'm going to look at those with the lowest debt-to-equity ratio. And then I'm going to look for those companies that are showing revenue last quarter is above 4 quarters, and cash flow last quarter is above 4 quarters, and have free cash flow yields. And then go right down to $200 million market caps. And our study showed that this would outperform the GDXJ more than 90% of the time on rolling 12-month periods going back a decade. So after all that research, I launched it 2 years ago. And Jay, I'm happy to tell your listeners, and we talked about it in your show when we just launched it, it's outperformed the GDXJ by 16% in 2 years. And I believe year to date, the last time I looked at it, it was beating it by 10%.
Wonderful.
So I think it's an intelligent way that if you own the GDX and GXJ, you have the same fee structure, but you have intelligent stock picking by U.S. Global for New York Stock Exchange. Go gold, go AU.
And so you, just with 30 seconds left, Frank, so you can change the composition of this 28 stocks from time to time. Is that right?
Well, that's a very good question. 30% are royalty companies, Jay, because the superior, superior business model. and they rebalance each quarter, but the other names change every quarter, so it's actively changing every quarter. And the biggest opportunity took place this time last year when Vanguard blew out of the gold stocks right at the bottom, and we had great stocks being sold out, and we bought them, and that was the biggest turnover. Otherwise, turnover has been pretty slow, and these stocks have done what they've done. You know, they've outperformed all the active gold fund managers and other ETFs.
Okay, we'll have to leave it go at that. Frank, thank you so much for being with us today. Folks, it's usfunds.com, usfunds.com. Go there, learn more about all that Frank and his team are doing there. A very good story.